Okay, so chapter 8 is really, we're going to be diving deeper into the topic of receivables. Um, so again, receivables. We've already talked about what receivables are, I think, since the chapter 2 or even chapter 1. But now we're going to be talking about a little more detail. We've been assuming certain things about the receivables, i.e., that they're all going to get paid, right? But that's not the reality because people will not always adhere to their obligation to pay you money. So we're going to talk about how that is accounted for. Um, so we're going to have two kind of different methods, the direct write-off method and the allowance method. So we're going to talk about the difference between these two and how they're related to this idea of bad debts, meaning you've extended credit to your customer. You've provided them services or sold them something, and they're owing you money, but they don't pay you back. How do you uh, account for that? And there's two different ways to do it. Okay, two different broad methods, and so we'll talk about both of those. Um, And then within this allowance method, there's like extra details. There's three kind of different methodologies. So the percent of sales, percent of receivables, and aging of receivables. So we'll talk about within this allowance method, these three different sub methods, you can say. And then besides accounts receivable, we've mentioned that there's this thing called notes receivable. Does anyone remember what the difference is between an account receivable and a note receivable? Exactly. Yeah. They're usually longer term. They're going to be formalized by some contract. There's going to be a loan agreement between the parties. So we'll just talk a little bit more about that, how to compute the interest, which we've kind of touched on, but we'll spend a little more time with that just to get some extra practice. And then also what happens when those notes receivable are not paid. So how we deal with that. Then we have some ratios at the end that we'll talk about.